Welcome back to the channel. I'm Dee, this is Market Stalkers, and today we're going to be discussing the difference between time-based profile and volume-based profile. One question that I keep getting from a lot of my traders is, do you use volume? How do I start using volume in my trading? Do you teach how to trade with volume? And that's fine, but there are also loads of people who interchangeably use terms like order book, order flow, time and sales, and depth of market ladder, aka the DOM, thinking that it's all the same thing. I just wanted to clarify a little bit about what these terms actually mean, and more importantly, just how different is that time-based profile versus the volume-based profile. First up, let's talk about depth of market, the ladder that you see on most futures platforms. But the depth of ladder is definitely not the same thing as time and sales window. DOM only ever has limit orders displayed, right? Orders that are waiting to be executed. And these limit orders can also be looked at as the number of units that are available at a particular price for anyone looking to enter the market. Anyone. It could be Joe working at Morgan Stanley, or it could be your mate Dave down the road, or it could be me. So anyone, right? Because without a market order, these limit orders on the ladder will never get filled. So you have to have someone, doing the button press and initiating a trade for X number of contracts. And that is where time and sales comes in. So time and sales are real-time orders going through, but that's not an order book. And also trying to trade through time and sales during today's electronic exchanges, all of the orders just happen so quickly, and attempting to sift out reasonable information out of it, it's just extremely hard. And frankly, if you want to do that, there are better tools out there that will give you the same information in a much more kind of transparent, easily interpreted graphical representation. Now, since the DOM ladder has limit orders on it, I suppose it can act as an order book as well. But order book, meaning limit orders, it actually means the limit orders of an institution. And clearly there are many, many institutions out there, and no, not every institution knows where all of the other institution orders are located. Some institutions are also only there to provide liquidity, right? We need liquidity to trade. And most exchanges today rely on limit orders quite a bit to generate that liquidity. So the role of a market maker is to fill a certain volume at these sort of nearby limit orders, moving the price up or down. And how does the price move up or down? Well, once the orders are chewed up at one price, the ladder moves to the next price. That's how it works. It's a very simple mechanism. But that's why you don't want to be involved during that sort of first half an hour to an hour of the exchange open, because that's when the market makers are doing their thing. They're trying to generate as much liquidity as possible. If you want to see where hedge funds and commercial hedges have their massive orders, well, you can have a look at supply and demand areas on large time frames, daily chart, weekly charts. And that is also considered order flow. And why? Because institutional limit orders will typically be placed at areas of previous large originating swing extremes, visible on the daily, weekly, monthly charts. And when you're looking at the chart in that way, you will automatically come up with sort of buy low, sell high scenarios. Obviously, if nothing is drastically changed in the underlying market, that's another can of worms, which we're not going to touch right now. Now, hedge funds and asset management firms, they don't really do your kind of tiny little 2 to 5 lot trades. We're talking wealth management firms who are usually managing portfolios of high net worth individuals. So that's like many, many millions. When you're working on those kind of portfolios, we're talking positions of about 3,000 to 5,000 standard lots. And because of the size of the positions, institutions will spend many days and even many weeks trying to position themselves. But the problem is you don't have one single price where, you can have 5,000, 10,000, 15,000 contracts available at, $60 or something. Instead, you're going to get a partial fill at one price. And then once all of the available limit orders have been taken by the market orders, price will then either rise or fall, depending on which side of the DOM falls to zero contracts first. And there's been this analogy that's been kicking about, and it's quite a good analogy about chopping a tree. So you chop a tree a little bit, chop it a little bit more, chop it a little bit more, chop a little bit more, and then when there's nothing left, the tree is going to fall. It's the same thing with supply and demand areas. Now that is why when the price reaches a potential area where the large institutional orders might be waiting, the price will typically start to consolidate. It will start to move sideways. It's going to start creating a bracket. If you go and watch my weekly strategy video from the 2nd of March 2021, I talk about gold and overlapping value areas. Now, value areas are distribution curves. That is where 70% of the business took place in a particular session. And when you start to get overlapping values, that means that the price has stopped moving for whatever reason. You have a couple of days when the distribution curve has stayed pretty much at the same spot. That indicates price is getting accepted. And that's also why you can start to speculate that there are plenty of orders waiting there, and it's preventing the price from going through the level. I like to call these areas congestion. I live in London, so it's a pretty appropriate terminology, because it is really like a traffic jam. A lot of cars in one area. It means that you're not going to advance very far until the congestion is cleared. And then if you apply that same analogy to the prices, it means you will get a reversal, which will then be visible via some kind of a reversal pattern of some sort. That's why we look at candlesticks, right? And the most confident candlestick will be engulfing. That's like the simplest way to determine that the other side has won. And the larger the time frame, the more reliable the pattern is, because there's more trading information that goes into it. Now, the way depth of market ladder usually works is that the smaller units will typically be available around the current price. And then you'll see the larger units available further away from the current price. And that's nothing more than just your institutional supply and demand. Then we come to order flow. So let's start by looking at what order flow isn't. Order flow is not looking at time and sales and trying to figure out who's got control. Order flow is nothing more than trying to evaluate how successful or unsuccessful the move is, or was, if you're looking at older supply and demand areas. How did it arrive at the level? Did it get there without creating congestion areas on the way up or down? Are there any signs of the move reversing? Do we have a sustained auction in one direction away from initial balance from that day? Initial balance, what is that? It's the first hour of any exchange open. And then we use that, the initial balance range, to evaluate the market in context. So once you know all of this, we can hopefully take out the mystery of order flow, order book, time and sales, depth of market and all of that, and then focus on the question about the differences between using volume profile versus time-based profile. Are they really all that different? They're not. And why? Because the strength of the move is almost always correlated with the amount of volume that came into the market. Too many traders give way too much focus on volume as if it's some sort of a crystal ball, holy grail of trading, all the while neglecting two things that, in my opinion, are actually a lot more important, which is time and strength of the move. How long has the move been going on? How large is the move inside a given time period and average size candles? All of that is pretty important. Whereas volume, it's always more of a supportive factor. Volume is not going to tell you which way you're supposed to be trading. So volume is just one element. On our Blahtech market profile, we have both the TPO value area, but also the volume value. So let's just have a look at it, see how different they are. All right, so what I've got here, so I've got both of them displayed. Let me just flip around this volume, because these are volumes, right? Now, baby blue is your TPO value area, time, price, opportunities. So that takes into account time and price. And then you have the volume value area. So as you can see on this particular date, they're a little bit different, but it's pretty similar actually. What is this? This is like 10 ticks difference. Now I'm going to use Blahtech backtest mode to go back in time. It's one of the very innovative features of our indicator, very useful if you want to see what's happened before. For example, this is the value area from one of the Wednesdays, and you can see this is the volume value area. They're pretty much the same. They're the same levels, almost to the tick, right? And that will be the case on most of the days. And here we are again. So you have the TPO value area, baby blue, and you have the volume value in yellow. It's not normally yellow. I just wanted to, have a better color so you can see the differences between the two. Here's another day, previous day, pretty much to the tick. And another one, in this case, TPO value is slightly bigger. So as you can see, they're remarkably similar. So for me, I trade a lot through time-based concepts. How much time is the price spending at a particular level? Volume doesn't show you that. And for me, that is a flawed approach because it only gives you one part of the picture, one small part of the entire auction process. Therefore, what really matters is not whether you're going to be using TPO value or volume value area, but instead where the volume signals are actually happening. Are they happening inside or outside the value area? Is the price accepting or rejecting value? And if you're using the same calculation to create both of the value areas, then there's very little differences between the two. And in fact, I'm going to go on record to say that TPO profile is much more transparent than just the volume profile. Because with volume, there is no time component. In case I haven't mentioned that already. And time is, it's pretty important, especially with the products that we're used to. If you're just trading through volume, all you're going to be left with is just volume nodes. And again, depending on where and how these volume nodes are happening, you can have very high volume that means completely different things. So can low volume. Markets can actually trend in low volumes too. So it's definitely not as simple as, hey, I've got a high volume node. It's got to act as a support or resistance. And without time or any other context reference of what should be happening at that area at that particular time of day, it becomes a very kind of flimsy, low probability, flawed approach at evaluating the market. By the way, if you're liking this video, I would love to have you here as a part of my little Market Stalkers family. So press the subscribe button, turn it gray, like my real hair color. And also, you might want to press the notification bell so that you don't miss any future uploads. Anyways, where was I? Oh yeah, volume versus time profile. Now, if you combine volume with something like a very large candle move for a particular time period, that's a whole different story. For example, if you see something like this candle here, it's quite large, right? And some people who are a little bit inexperienced, they would be like, oh my God, new trend, it's all falling. But if you see an extraordinarily large candle that also has a very high amount of volume coming in very quickly, also known as the high volume churn, that's very likely going to be a fake out. So for profile traders, you have value acceptance. The market opened outside of value, fell into it, but how did it fall? It fell into the value with a super explosive, massive candle with a ton of volume that accompanied it. So these kind of candles that fill the entire daily range in, the space of 30 minutes, that's an anomalous event that is also accompanied by anomalous volume. And that rarely brings a continuation move. In fact, usually these sort of moves, like you see here, they end quite quickly. And that gives way to a reversal trade. So if you know all this statistical daily ranges, looking at how fast is something moving within a certain time period, all of that can give you very, very valuable information. So large volume, in this particular case, it means a low probability of a continuation. And that's why when I see novice traders who are getting super excited over a massive move that happened right off the exchange open, they're like, yes, there's going to be a massive... It's not going to be anything, okay? It's actually going to be a fake out. And then I usually catch the move and they're like, how did you know? Because I've seen it about 500,000 times. That's how I know. That's all the wisdom that I've got for you this time around. Feel free to check out the description box down below. There's a link to my market profile Udemy course. If you're someone who is struggling with their intraday trading performance, you'll definitely want to look into using institutional order flow concepts. It's no accident that Market Profile to this day remains the most commonly used tool of successful prop traders. And here are a couple of other videos that may interest you if you're struggling with some typical trader issues, so feel free to check those out as well, and I'll see you guys next time.